The infinite banking concept was first introduced by Nelson Nash in the book, Becoming Your Own Banker, in the year 2000. To become your own banker, you need a whole life insurance policy, structured to maximize cash value with a dividend-paying mutually held life insurance company. The first thing you need to understand is the power of compound interest, and how it accelerates over time. The second thing you need to understand is the difference between average rate of return and the real rate of return. The average rate of return is the sum of all the percentage earnings, including all positives and negatives each year, then dividing that total number by the amount of years. The real rate of return is just the percent difference between your initial investment and the final amount of money you end up with. Here are some examples of the different results when one calculates the average rate of return and then compounds it in a linear manner over time to project or illustrate greater results in the future, versus the actual return on investment over the same period of time. A few things you need to take into consideration when you choose to participate in a qualified plan. Number 1. You give up access to your capital till age 59.5. Otherwise, if you take it out before then, you pay a 10% penalty plus whatever tax bracket you fall into. Number 2. From 59.5 to 70.5, you can withdraw your money without penalty, but you still pay the tax. Number 3. After 70.5, you are required to take a specific amount of money out and pay your taxes on that money. In case you decide not to take out required minimum distributions, you pay a 50% penalty plus the tax when you do decide to take that money out. In a properly designed whole life insurance contract, 94% of the money you put in goes directly into an account called the cash value. The other 6% is spent buying a life insurance death benefit that will transfer to your heirs 100% tax-free when you die. You could also have access to it while you're still alive, in case of an emergency, where you suffer from a chronic, critical, or terminal illness. These are called living benefits. The cash value account in this example has a guaranteed growth built into the contract of a 3.5%. It also has an annual dividend payment to the policyholders. In May 2023, Foresters Financial announced that the total payment credited to the cash value account of its policyholders was 5.8% of its total current cash value. This dividend payments vary every year depending on the company's surplus or profitability that year. The cash value account compounds every year, as you can see in this example, and it can be accessed tax-free through loans against your cash value, while the cash value stays inside the policy, compounding the interest credited every year without getting interrupted. The loan interest rate is set by the company at the time of the loan. In this particular case, in May 2023, the loan rate would have not been more than 4.47%. The purpose of this concept is to make your money perform multiple functions at the same time. Here are 3 ways people buy assets. The first one is called the debt cycle. A person borrows from a third-party lender to buy an asset, and makes payments until the debt is paid off. This usually has cost. The lender charges interest on that loan at a given rate, depending on the person's credit score. The second option is called the cash cycle. The person saves money until they have enough to purchase the asset with cash. In this scenario, the person did not spend any extra money on interest to any bank or third-party lender, but still had an opportunity cost, which is the fact that they missed out on the money they could have earned on interest, and could have compounded over time. The third option is utilizing the infinite banking concept, where a person first saves the money in cash and runs it through a cash-accumulating life insurance contract, so that it can collect the interest or dividend paid out by the company to its policyholders. Then the person can borrow up to 100% against the cash value in the policy, then buy the asset with that money, while their original money is accruing interest inside the policy. In this example, the person with the policy shown previously The policyholder made 5.8% on the money inside the policy, and would have only spent 4.47% on interest on the loan against their cash value to buy the asset, making a positive spread of 1.3%. All while at the same time, having a life insurance death benefit in place to protect their family, having living benefits in case of an emergency, earning compound interest on their money, and still had access to 100% of the money tax-free, since the money was taken out through a loan to purchase the asset they wanted to buy in the first place.